Here's something that surprises a lot of Canadian retirees. Every single year, billions of dollars in legitimate tax credits go unclaimed. Not because people are dishonest, but because the rules changed and nobody told them. And right now, in 2025 and 2026, the Canadian federal tax system is going through one of its most significant structural shifts in years. If you're 65 or older or approaching retirement, this could directly affect how much money you keep at the end of tax season. Today, we're breaking down the age amount credit, the pension income credit, medical expense strategies, home renovation incentives, and the caregiver credits that far too many Canadian seniors leave on the table. Stay with me because later in this video, I'll explain one specific change coming in 2026 that could quietly cost you hundreds of dollars if you're not prepared. Let's start with something that affects almost every Canadian senior: the age amount tax credit. This is a non-refundable federal credit sitting on line 30,100 of your tax return, and it's specifically designed to reduce the tax burden for Canadians who are 65 or older by December 31st of the tax year. For 2025, the maximum base credit amount is just over $90 short of $9,000. For 2026, it rises to just above $9,200. That's a meaningful number. But here's where things get interesting. Not everyone gets the full amount. The credit starts to phase out once your net income goes above a certain threshold. In 2025, that threshold sits at just under $46,000. In 2026, it inches up slightly. For every dollar your income goes above that line, the credit shrinks by 15 cents. So, if your income is comfortably below that threshold, you're getting the full benefit. If you're above it, you're still getting something, just less. And the credit disappears entirely once your income climbs past about $107,000 in 2026. Most Canadian retirees will land somewhere in the middle of that range, which means there's real money available to them and real money to protect. Now, here's a detail that many people don't think about until it's too late. If you immigrated to Canada or left Canada during the tax year, these amounts need to be prorated. The number of days you spent as a Canadian resident determines both your maximum credit and the income threshold that triggers the phase out. If you or someone you know moved to Canada later in life to be closer to family, this rule matters. Make sure you or your tax preparer is calculating this correctly, because getting it wrong means either leaving money behind or, in the other direction, overclaiming. Let's talk about your province, because this is where most seniors get tripped up. Every province has its own version of the age amount credit, and the numbers are different, sometimes significantly different. Ontario's maximum provincial age amount sits at just over $6,200 in 2025. British Columbia offers just under $5,800. Manitoba is considerably lower at around $3,700. Newfoundland and Labrador is actually one of the more generous provinces at over $7,000. These aren't small differences. If you've recently moved provinces for retirement, we'll say to be closer to grandchildren or somewhere with a lower cost of living, the provincial credit you're eligible for could be meaningfully different from what you were used to. Quebec operates under its own framework entirely, where the age credit reduces based on family net income, not just individual income. That's an important distinction for couples. Now I want to talk about something that has the potential to save Canadian couples hundreds, sometimes thousands, of dollars every year. It's called pension income splitting, and while many retirees have heard of it, most don't fully understand how much it can do for them. Here's how it works in plain terms. If you have eligible pension income, think payments from an employer pension plan or income from a RRIF or LIF if you're 65 or older. You can allocate up to half of that income to your spouse or common law partner's tax return. No cash actually moves. Nothing changes in your bank account. It's a paper election you make using Form T 1032 when you file, but the tax impact can be very real. Imagine a retired couple. Let's call them Robert and Margaret. Robert spent 30 years in manufacturing and receives a defined benefit pension of $56,000 a year. Margaret worked part-time most of her life and receives a much smaller income. Because their incomes are so different, Robert is paying tax at a higher marginal rate on a large chunk of his pension. By splitting up to half of that pension income with Margaret, some of those dollars get taxed at her lower rate instead. That saves the household real money. But there's a second benefit that most people overlook entirely. If Margaret doesn't have any eligible pension income of her own, receiving at least $2,000 through this split automatically gives her access to the pension income credit on line 31,400. That credit is worth up to $290 federally in 2025, and when you add in her provincial credit, the combined household savings can easily reach $600 or more, all from a single form. And here's the third reason pension splitting matters, especially as income grows. If Robert's income is approaching $93,000 in 2025, he's getting close to the threshold where the OAS clawback kicks in. That's the recovery tax the government charges when your net income goes above a certain level, clawing back 15 cents of OAS for every dollar above the threshold. By shifting income to Margaret's return, Robert's net income drops, he stays below that clawback line, and he keeps his full OAS benefit. That's not a small thing. Before I explain the change coming in 2026 that I mentioned at the start, and it's one that directly affects anyone planning a home renovation, I want to quickly mention that if these retirement tax updates are useful to you, I'd love it if you subscribe to Canadian Retirement Benefits. We produce clear, practical content designed specifically for Canadian retirees and those approaching retirement. Now, let's get to that 2026 change because it genuinely surprises people. Right now, in the 2025 tax year, if you make an accessibility renovation to your home, a wheelchair ramp, grab bars, a walk-in bathtub, widened doorways, you can claim that expense under two different credits simultaneously. The Home Accessibility Tax Credit, on line 31,285, and the Medical Expense Tax Credit. That's sometimes called double dipping, and for 2025, it's completely permitted. On $20,000 of qualifying renovation expenses, the home accessibility credit alone could reduce your federal tax by $2,900 in 2025. Starting in 2026, that double claim is gone. You'll have to choose one or the other, not both. So if you've been thinking about making accessibility improvements to your home, 2025 is the last year to claim both credits on the same expense. That's the detail I mentioned at the start of this video. And for many seniors, the difference in tax savings between claiming both credits versus just one could be several $100s. Now let's talk about medical expenses because this is an area where the right strategy makes a meaningful difference. The medical expense tax credit doesn't apply to every dollar you spend on healthcare, only the amount that exceeds a threshold. That threshold is either 3% of your net income or a flat cap of around $2,800 in 2025, whichever is lower. For most retirees with modest to moderate income, the 3% rule applies. Here's a practical tip that many Canadians don't know. You're not required to claim medical expenses on a strict January to December basis. You can choose any 12-month period that ends within the tax year. So if you had a major dental procedure in November of last year and a significant prescription cost in February of this year, you could combine them into one claim instead of splitting them across two returns, potentially pushing you over the threshold in one shot rather than falling short in both years. And if you're a couple, pool your medical expenses on the return of whoever has the lower net income. That lowers the 3% hurdle and maximizes what you can claim. For a spouse with a lower income, 3% of their net income is a smaller number, which means more of your combined medical expenses exceed the threshold and qualify for the credit. For Ontario residents age 70 or older, there's an additional layer worth knowing about: the Ontario Seniors Care at Home Tax Credit. This is refundable, which means even if you don't owe provincial tax, you can still receive it as a cash refund. It covers 25% of eligible home care medical expenses up to $6,000 for a maximum of $1,500 per year. There is an income phase out starting at $35,000 in family net income, fully eliminated at $65,000. But for many lower income seniors aging in place, this credit is genuinely valuable, and many don't know it exists. Let's take a moment to talk about families who are supporting aging parents, because the tax system has a credit specifically designed for this situation that goes consistently unclaimed. The Canada Caregiver Credit recognizes that many adult children are quietly covering the costs and the time of supporting a parent or grandparent with a physical or mental impairment. Importantly, the dependent parent does not have to live with you. As long as you're regularly helping with basic necessities, food, housing, daily care, you may qualify. Think of someone like Karen, a 58-year-old woman in Winnipeg who helps support her mother, who lives on her own but struggles with mobility and relies on Karen for groceries, medication management, and transportation to appointments. Karen may be entitled to claim the caregiver credit on line 30,450. The maximum base amount is over $8,600 in 2025. That credit starts to reduce once her mother's own net income exceeds about $20,000 and phases out fully around $29,000. If Karen has a sibling also helping their mother, they can split the claim between them. The combined total just can't exceed the maximum allowable base. And if a family member qualifies for the disability tax credit, which requires a medical practitioner to certify a severe and prolonged impairment using Form T-2201, the credit amount is over $10,000 federally in 2025. If the person with the impairment doesn't have enough taxable income to use it, the unused portion can be transferred. To a spouse, it goes on line 32,600. To another supporting family member, it goes on line 31,800. For families who haven't explored this, a retroactive claim going back up to 10 prior tax years could mean a very significant refund. So let's bring this all together, because there's a lot here, and I want to make sure you leave with the things that matter most. The age amount credit is money you've earned the right to claim. Make sure your province's version is being claimed too, not just the federal one. Pension income splitting is one of the most powerful tools available to couples in retirement, and it delivers multiple benefits at once: lower marginal rates, access to the pension income credit, and OAS protection. The 2025 tax year is the last year to double claim accessibility renovation expenses under both the HATC and the medical expense credit. So if you've been planning a renovation, the timing matters. And if you're supporting a parent, a spouse, or another family member with an impairment, there are credits available that recognize that contribution, but only if you claim them. Tax season can feel overwhelming, especially when the rules keep shifting. But the goal here isn't to make things complicated. It's to make sure that the credits you're entitled to actually end up in your pocket where they belong. If you found this helpful and want to stay informed about CRA updates, pension income strategies, OAS and CPP changes, and retirement tax planning for Canadian seniors, please consider subscribing to Canadian Retirement Benefits. Thank you for watching, and take care of yourself.